Howdy, Jake here. Today we're looking at the company Avnet, company 69 of our generic stock screener in the electronic equipment, instruments, and components industry. Just under 5 billion market cap on 7 billion enterprise value. So we're looking at a lot of net debt here. And growth is relatively flat from 10 years ago, but up maybe 3 to 5% CAGR from 8 to 9 years ago. Looks like there was a sell-off here in 2015. Let's see if we can. Oh, okay. We're not seeing that on our end. So I find that interesting. I mean, I know it does look fairly cyclical, but I mean, 36% drop off is pretty crazy. Gross margin, just about 12%. That's pretty poor. It means cost of goods sold is really digging into that revenue. But operating margin, 3%, pretty in line. I mean, it's a little bit better than like a Walmart or a consumer staples store. Pretty solid production of earnings per share, more growth there, so that's positive. More growth there than revenue. They're becoming more efficient with the money that they do make, and so much so where the most recent 2 years are actually 10, 11, and 12% return on invested capital. So let's look at that balance sheet a sec because we saw a lot of debt. So 288 million cash on hand with 3 billion long-term debt. So well over double long-term debt from 10 years ago, from 1.2 billion to 3 billion. And that 3 billion in relation to their free cash flow is, it's been negative last year. I mean, let's even lean on the higher end of like 300 million. Then, yeah, it's 10 years. So again, debt doesn't get taken into consideration immediately with the present value calculation that I do and with the present value of earnings calculation that the average individual does. But you can take it into effect in your discount rate, or you can have your price to earnings and price to free cash flow terminal values be based on enterprise value rather than market cap. I've noticed that those are two different ways to be able to take into consideration debt in a present value calculation, whereas normally you're just looking at earnings and free cash flow based on market cap, and it doesn't take it into effect. So please be mindful of that when you do your own analysis, that you will want some margin of safety based on the fact that 10 years of their 5-year average free cash flow is how much debt they have. That's a very strong amount of debt, and so please just take that into consideration. And now let's see what their use of cash is. So share repurchases is a little bit. The dividend pays out 111 million in aggregate. Compared to that 300 million, it's 35%. So nothing too terrible. They're not paying so much to the dividend that it's concerning, and quite a bit to share repurchases. It looks like, on an average basis, maybe 40% to 50% of the free cash flow goes towards that. But the company is going to have to start focusing on that debt reduction. So although you have to take that into consideration, you have to take the past into consideration, but you also have to take in what you want them to do into consideration. So you have to balance the two of them, and it can't just be, the company has never bought back shares, but it's a 5 PE and they should be buying back shares like crazy. If they've never done it, don't expect them to do it. But you can be like, okay, maybe they'll buy 1% of shares, possibly, and then your analysis can change if they change their own analysis. So if the company changes management or changes their own ideas and use of capital allocation, then you can change the way that you calculate the business. But for now, I would say a little bit to the dividend, a little bit to share purchases, and then the rest, please reduce this debt figure. Stop making acquisitions you can't afford through free cash flow and organically, and pay down a little bit of that debt. So let's start making some assumptions here. I would say I feel pretty positive about a 5%, and then just because I'm going to base the terminal value more so off their enterprise value being quite a bit higher. So I would have put maybe 15 or 16, pretty much market average, but due to their enterprise value being so much higher, I did reduce that figure. And margins are not great, but maybe let's do 2.5. Let's do 2.5 to share change. I think that's actually being generous. Let's do 2 and 1.5 with a share change. Keep changing it. When it's this low, it gets kind of tough because the difference between 2 and 2.5 is a 25, 20 to 25% difference. And you're looking at a pretty big range there. But I think I feel comfortable with that. Share change, if they buy back $36 million to offset stock-based compensation, and then $50 million, you're looking at $86 million. $86 million plus their $100 million. That still leaves 33% of their money towards debt reduction. I feel pretty good about that. So it's a 1% reduction. And then this dividend, they've increased it here. I might increase it 1% over here so that by the end of 7 years, the company is paying maybe 25 to 30% to their dividend, 25 to 30% for their share purchases, and then 40 to 50% to pay down that debt. And so here, the future price signals to fall 18% to use the price we're looking for here. I mean, this 5%, I can honestly see that happen. I mean, if you look from 2015 to 2023, it is about 4 to 5% CAGR. The use of free cash flow is pretty interesting. I would really, for investing in this company, I would need to make sure that they understand that you cannot just keep increasing debt to fund projects. It gets to a point where debt comes due. You're going to have to sell off assets if you can't refinance, and you can't refinance when your leverage ratios are too great. And 10 times free cash flow, to me, I'm not a lender. I'm not lending out to them, but to me personally, it seems like a lot. So they definitely need to figure out how to reduce that. And for you as the investor, that means less of that less of that free cash flow is going necessarily towards you as the shareholder. Yes, it is reducing debt, which is a positive thing for a business, so it doesn't go under, but it's less money directly in your pockets, either through share repurchases, dividend, reinvestment. And so you do have to keep that in consideration as well. But I do hope you enjoy the video. Thank you.